I'm David Bank, editor and CEO of Impact Alpha, and this is a special Institutional Shift edition of the Agents of Impact podcast.
Everyone likes to believe that there's a magic moment in time when everybody gets it. The reality is that about 10 or 15 or 20% of the companies or individuals get it, and they run ahead and they take it.
That's Dave Chen, CEO of Equilibrium Capital, the Portland-based manager of sustainable real assets. Dave has been one of our guides to the institutional shift as the world's biggest pools of capital gradually and then suddenly change course. As he has for several years, Dave joined me to look out over the big themes in sustainable finance in the year ahead. Let's jump right into our conversation. Hi, Dave.
Hey, good morning.
Hey, we've been doing this now for at least 4 years, this sort of year ahead, year roundup of predictions and trends. I will say you're pretty damn good at framing it up for us. So we're gonna let's dig in. As you said in the warm up, we've been doing this for a long time. Now people are listening. Now people care, right?
Yep.
This stuff has gotten so real, both on the level of the systemic risks, as they say, and also of the opportunities and solutions that are coming up. And just give our listeners the briefest context of what Equilibrium is and how you know anything about this.
Yeah, we founded the firm in 2008, and we are one of the wave of investment managers that targeted sustainability as a competitive advantage and targeted the institutional investors, specifically pensions and sovereign wealth funds, as the source of capital for where we compete. And we've been historically players in the real assets categories.
So let's leave that. The one thing that folks should know is that we call this the institutional shift because, as you said, you optimized Equilibrium for kind of institutional investors and indeed have attracted and institutional investors. So you know something of what the pension funds and others are looking for and investing in. And let's actually start there because that's kind of the headline. I mean, what are we seeing in the institutional shift?
So here's 5-6 topics that I think, as we look out into 2022, we certainly will be focused on, and I think that in terms of the hot trends or the hot topics or the hot predictions. Number one, the benefit corporations go mainstream. So what started in 2008 and 2009 as part of the B Corp and B Labs movement really takes a hold this year, and you're going to see the public companies, the global companies, the Global 500 type companies starting to sincerely debate the benefit corporation laws, the benefit corporation, I'll call it governance construct, and really start to question the rollback of the Milton Friedman shareholder supremacy philosophical driver for corporate behavior.
Okay, Dave, I'm going to stop you right there because this one we're going to give you a point in advance because no less than Larry Fink has said that he wants to see corporations at least consider this as well. So strangely, this benefit corporation idea has gone from the fringes to the mainstream rather quickly.
Leo Strine, who was the chancellor of the Chief Justice of the Chancellery Court of Delaware, was dying to have a case presented to him before he retired, and it took a little bit longer, but I think this is the year that the law gets exercised. The second major thing that's going to happen, and one of the things that we always have to appreciate is that there is a gestation period for all great thinking, and regulators globally this year will start taking the issue of climate risk seriously as a financial risk. So the Mark Carney speech of 2015 at the Bank of England. This year, I think
the tragedy of the horizon, I believe it was called.
Yes, will now become regulations and law. And SASB this year will complete the consolidation of standards on a global basis. and with the full support of regulators and of major authorities around the G8.
The
So Janine
the
Galat becomes a very, very important person over the course of. She already is, but in 2022, this is now going to be a global leadership position that I think exemplifies the regulators' seriousness about this.
Well, and there has been, as you say, a kind of consolidation around these, some people sort of, sort of dispatch it as, the alphabet soup, but there is kind of a consolidation around what has to get measured and reported, and a kind of new way that corporations have to institutionalize this into everything from, their balance sheets to everything else. So what is that, that sounds like a good thing, but what is that going to actually, drive? Why does it matter that there's now sort of sustainability reporting, and that's kind of getting increasingly standardized?
Yeah, I mean, I think that one of the things that it won't do is create what I think is a somewhat unrealistic expectation for a unified picture of what sustainability and goodness is. What it will do, though, is it will increase the kinds of ways that these things are in fact measured. So, in other words, it doesn't make it easy that with one simple number or one simple attribute, you'll be able to make decisions on whether a corporation is being sustainable and managing their climate risk or not. But it will make that set of data now I'll call it an auditable,
Yeah.
legally attributable uh, function. So I think it's a massive step forward. But this category has had this mythology for a decade now that there'll be this magical metric that will make judgment easy. It won't, but it will increase the legal assertion of these kinds of data.
I think there's another side of the coin which plays into this, which is also happening, which was going to be one of my predictions for the year, which is the rising price of carbon around the world, which is a sort of a proxy or a leading indicator of sort of pricing nature and pricing a lot of things that used to be considered externalities. And as you combine that phenomena with what you're just talking about, you start to actually get some real numbers and some real economic, drivers in corporate accounting. So the carbon markets in 2021 were up very strongly, and people I think that this year too, as sort of regulatory compliance regimes tighten up, that the supply and demand things curve will make prices go even higher. So you started to get something people have been talking about again for many years, but finally happening. A real price on carbon.
That was actually my number 3 item for
I'm
this
glad
year.
I got it in before you then, Dave. You got to save a few for me.
Carbon is not a fad, and it's a lot harder than it looks. And I would say that 3 things are going to become apparent this year. One is that carbon is the carbon credits themselves and all the various environmental services that go along with that are going to be understood to be actually a commodity in a sense of they follow a supply demand curve. And we're going to find that the development of supply is so woefully under what is now emerging as this, I think, wave of demand.
Just to be clear, what we mean by supply and demand here: supply of projects that meaningfully and significantly and verifiably reduce or sequester and carbon, and then the demand is companies and others buying that for either to satisfy their voluntary net zero commitments or their mandatory compliance in various
You
places.
know that old movie, Christmas movie. Every time a bell rings, and it means that an angel got a set of wings. Well, every time a net zero commitment is made, a ton of carbon commitments were just made.
And these are, again, this is one of these things people have talked about for a long time, but now that is fetching, at least, upwards of $20 a ton, and sometimes even higher. And the different markets obviously have different pricing, but it becomes, and the expectation that it's going higher itself has its own sort of self-fulfilling prophecy as everybody starts to make decisions about investments and other things are based on the price of carbon. It's actually rather phenomenal.
To use that fancy language, it is clearly a market signal, which leads me also to uh, uh, expect that within the carbon markets, as much as everyone loves the idea of exchanges and marketplaces, because of the strategic nature of carbon, we're going to see massive point to point trades, bilateral agreements. In other words, when you have a company that needs $1 billion worth of carbon inventory to fill their demand side, they're not going to the open market and the merchant market. They're going to contract for it. So just the same way that stocks trade both in point-to-point block trades as well as on open exchanges, you're going to see I think the big activity in carbon being point-to-point trades.
And that's possibly a step in the direction towards a sort of global interoperable market. But I think you're right that people have sort of given up on the hope for one single market. And I think, whether it's blockchain and crypto, or as you said, these point to point transactions and other things, that sort of there will be, de facto prices and a sort of clearinghouse prices and benchmark prices, and the way oil has in other commodities, right? And as you say, carbon may become the most important global commodity. If you listen to Mark Carney and others, like you said.
Yeah, for us, our big aha this year is we're one of the largest producers of renewable natural gas in the country. And I think one of the big ahas for us is that we are actually producing not one commodity out of our RNG facilities, but we're actually producing 4 traded commodities that each have their own supply demand behavior. And I think that very, very small
Let's just
insight has really
let's just
changed our behavior.
just slow down and remind people what that means. That means dairy and other agricultural facilities sending you manure and other waste to digest in your biogas digesters and turn into natural gas that put into the pipeline. And you sell the natural gas just like natural gas, right? But you also sell the credits.
So we're selling natural gas. We're selling natural gas as a non-fossil fuel source because it's coming from farm waste and food waste. That type of natural gas, non-fossil based natural gas, has a value to certain fleets, truck fleets, garbage truck fleets, transportation fleets. And then we sell various forms of credits. And each of those are a separate, distinct commodity with their own separate pricing, their own supply demand curves, and their separate attributes.
But I think you were telling me you make more from the credits than you do from the gas.
The charts are remarkable.
And methane, which is the key thing there, as you said, is both priced higher and also more potent as a greenhouse gas, certainly in the short run, and so therefore, even more urgent to get it out of the supply chain. So they're really not just a carbon market; there's a methane market that's functioning, right?
That is correct. That is correct. Which leads me to the last thing about carbon in terms of a prediction, and that is I've not been a huge advocate for the use of crypto in various sustainability areas, but I do think that there is a very distinct opportunity for blockchain to be used, and that is that in some ways multiple entities and multiple parts of the value chain want to quote unquote get credit, no pun intended, for the carbon credit. And so we have our institutional investors asking us questions like, hey, if my capital created the opportunity for you to create this carbon credit, how do I get credit for doing that? They're not saying that they bought the credit. They're saying that my capital created the opportunity. And then, my answer back is well, in the same way that your capital and my work, our work, created that credit, and yet we don't get credit for that. All right. So I think one of the applications that will start to take place here is the use of blockchain to take a single, unrefutable carbon credit and then attach to it various attributes. The capital that fostered it, the intermediary that created it, and then the ultimate consumer or the holder of the credit. The farmer that, in fact, you know, had the cow that created the manure. So I think that there'll be multiple ways of thinking about this. In some ways, it's the same way that we think about GDP. And the fact that GDP has multiple hands in it. There's the miner of the iron ore. There's the steel manufacturer. There is the ultimate rolled steel that becomes potentially a car, and then ultimately the dealership that sells the car. All along the way, you're creating value from an original source material along the way. And I think that carbon credit is going to have a similar concept of thinking, which is who are the various entities that legitimately had a hand or a value add in the process on the way to the ultimate creation of the credit.
That's fascinating. It's kind of the flip side of what was going to be one of mine trends, which we called out the other day in Impact Alpha. Scope 3 will be a phrase that people learn in 2022, and it's sort of the inverse of that. It's the all of the direct and indirect effects of your operations in terms of the carbon emissions, and even the indirect use, like for example, in the classic case, is that the gasoline that is burned in your car is not counted in the scope 1 or 2 emissions of the oil company because you burned it in your car and it wasn't them that burned it. So, but when you count scope 3, you get these secondary effects, like you said, and you start to see the whole ecosystem of charges. And you're saying that you can get the flip side, you can get the credit for mitigating those emissions.
Yeah, and I think this will be an ideal use for the distributed registry and the blockchain technology. Uh, the fourth trend or I don't know, thing that we'll watch in 2022 is net zero shifts to and other than all these declarations of net zero becoming the boom time for consulting firms that will be doing these engagements and studies for how these companies will get to it. Uh, I think there's some pretty dramatic implications of this, and that is, uh, people don't like doing the hard things. Companies don't like doing the hard things, and so if I think about this as the road to net zero, I jokingly say that there's 3 phases of it. One phase is, hey, everybody in our company, let's tighten it up a little bit, so we'll use a little bit less energy. Number 2, hey, why don't we go out and get offsets and credits, and that'll help us. And then the third phase is, if you really think about what net zero means, I mean, we just got done with 100 years of building corporations, sectors, enterprises, business models, all built on consumption of energy. And, well, frankly, consumption of resources and environmental services. And to get to net zero, if you think about just that word, it means that we're going to reverse that trend. That means re-engineering of corporations, re-engineering of processes, re-engineering of markets and business models. And so, I remember at the dawning of the first Obama administration, there was a thing called the New Economy Coalition. Well, I think net zero's implication is new economy. And this is going to take, I don't know if it takes decades, but it's certainly going to be one of the major shifts that's going to take place in corporations across this decade. And that is the recognition that you're going to be re-engineering your corporation.
Let me ask you a question, because this is something you and I have talked about over the years, and there's always this fabled tipping point or inflection points, and we've been talking about the need for all of the solutions and the financing and the sort of deployment to go exponential, quote unquote, because the urgency is so great, as you said, net zero to you would think that once that ball starts rolling, that the acceleration could be very fast and the doubling could happen very fast, and things and goals that were set for 2050 become 2040, and 2040 becomes 2030, and things really speed up. I mean, that's kind of what has to happen for us to have a outside shot at sort of averting the worst effects of climate change. we know that can happen. We know the theory behind it, but we don't quite see it. I mean, carbon emissions ticked back up, in 2021 after dropping in 2020 because of the initial sort of pandemic shutdowns. And so, even when we got them down, we couldn't keep them down, and they're back up almost as much. And we don't have that many years to get this acceleration going. So, how do you see that acceleration playing out?
Gestation periods are long, and hope goes up and down during those gestation periods, and then, as you said, we hit these somewhat unpredictable inflection points, and from there on, and it starts to go through that S curve. And we certainly saw that with cell phones. We saw it with smartphones. We saw it with ATM machines. We saw it with the internet. And frankly, we saw it. IoT now sounds like old hat, but that was talked about for, again, 10, 15, 20 years. And there was innovation that was happening every year. It just didn't catch on. And I think you're seeing the same thing happening. And I mean, how would you like to graduate today as the top of your class in mechanical engineering or in thermodynamics, focused on blowing up gasoline within a cylinder?
Mm-hmm, mm-hmm, mm-hmm. The internal combustion engine sales, I think, in countries like Norway is something like 4% of all sales now. So it's like once it falls off the cliff, it's gone.
And it's going to hit, and everyone likes to believe that there's a magic moment in time when everybody gets it. The reality is that about 10 or 15 or 20% of the companies or individuals get it, and they run ahead and they take it. And the mythology is that everyone has a chance to catch up. But at the same token, we always jokingly talk about, well, gosh, I'd hate to be the buggy whip manufacturer. Well, we're seeing that, and the notion of stranded assets is now alive and well.
The leaders and the laggards theory, we've always thought of that as the sort of theory of change, like you say, that every sector, every industry, will split, and some people will take the chance to run ahead, as you say, just like they do in other sort of tech and economic disruptions. Which actually bears out one of your earlier predictions, Dave, which we took this year and ran with, renewcos. And everybody wants to spin out their EVs, obviously, but other kinds of renewable and sustainable businesses, because now all of a sudden those businesses are the hot businesses getting the higher valuations and the cheaper capital. And all of a sudden the shoe is on the other foot. And they want the EV unit, which has no revenues, is worth more than the old line business, which has decades or more of revenue. So Harley Davidson spinning out its electric motorcycles, and there's pressure on all the oil companies. There's activist investors pressing Shell to spin off its renewable assets from its legacy oil and gas. Renewcos.
Yeah, if you attend an oil and gas conference in Houston in 2021, you'd almost swear that was a revival meeting.
Because of oil prices?
No, singing the songs in praise of renewable energy and and the hallelujah of leaving the carcass of oil and gas behind, to the extent that LPs, limited partners in the institutional world, sometimes now are making comments and about the oil and gas partnerships that are now coming in, having had the newfound discovery of the importance of renewable energy. And so I think there's a lot of, quote unquote, this kind of change taking place, which in some ways leads to my fifth observation. And that is that I think in 2022, you saw it starting to happen last year and the year before, but we're going to start to see, and we're seeing it now, a significant generational shift in players and voices on this set of topics. It's going to be the classic crossing the chasm, Jeffrey Moore evolution of sectors story. Many of the folks that were the leaders of the quote unquote impact investing period are not going to be the ones that cross the chasm as this stuff starts to go mainstream, and you're starting to see it happen already. So in some ways it's an altogether different conversation. The vocabulary is different. Uh, the demographics of the applications, the demographics of the investors are shifting. So it's going to be an interesting time as the conferences that dominated this sector will become increasingly marginalized as we start to make this shift into the bona fide mainstream.
Well, let me take slight issue with that and give you a little bit different scenario, which is I think you're right in terms of the riding up the capital curves. You're seeing much bigger funds being raised. Yours among them, but others as well. Numbers that we would have not thought possible several years ago. And I think there is kind of a splitting out of that. But I think that some of the pioneer types that you say will be left behind may also continue to be pioneer types, and there's always a new frontier of sectors and geographies and population targets and customers and business models that requires a kind of frontier and experimental and innovative kind of sector, and some folks are sort of better suited to that. So I think they'll continue to try to move out to the next frontier, and the mainstream will follow behind that. My example of that, which I think sort of is what we're calling the S, and we've talked about this before, that that the S in some level is going to be as big or bigger than the E in ESG, the social aspects and the investment potential of the kind of rebuild, exactly the thing you were talking about when you said every corporation has to be re-engineered. Almost like every neighborhood has to be re-engineered, every apartment building has to be re-engineered, every car has to be replaced. That's a mass market phenomena that reaches very far down the sort of quintiles of income, such that it becomes something that requires sort of deep community, engagement and governance. It can't be sort of done just from the top. So I think what we're going to start to see is a lot of things that actually were in the early years of certainly community development kind of investing and small business finance and those sorts of things in neighborhoods and affordable housing finance, all of those very bread and butter kinds of financing things, which I know well, becoming if not growth sectors, at least very attractive sectors, the economics of them being, you've been the great teacher of mine in this, and things like affordable housing being a very stable and attractive institutional asset. And I think that we're going to start to see, local community-based financing, access to finance for entrepreneurs, access to finance for projects. And I think it might surprise people how big and exciting this very stodgy, sector, has become.
I think therein, what you've just described is the main thesis in that model and in that book of Crossing the Chasm. What you've described is the market sector evolving. It doesn't necessarily translate that the early pioneers in that will be the ones that serve that sector growth. There's always an assumption that the pioneers will grow to be the ones that emerge as the mega players that create the change once that market inflects. And history would tell you that that's actually not the case.
I agree. That's the innovator's dilemma in a nutshell right there. And actually, our example has been this past year, which we called out, we in emerging markets, the small business finance sector. One of the great silver linings of the pandemic was the massive and accelerated digitization of small businesses in emerging markets, just to be able to keep open. And once that happened, it opened up all kinds of new channels for financing businesses that the fintechs and others moved into, because they had lower transaction costs and they had access to the customers and they had ways of underwriting that were different than, and all of the pioneers, like you said, even some of the old guard, microfinance institutions, but certainly the banks and others couldn't keep up with that. And so we're seeing a new way of financing small business in emerging markets, which has been the kind of holy grail of development types for decades, all of a sudden being taken over by enterprise software providers and new fintechs, and not the development banks and a lot of the mechanisms. So the disruption is real.
And you guys have been writing about a related topic, which is the legitimization of the word catalytic capital. And I think in a funny way, you know, the writings that have gone on in this last few weeks about some of the NGOs that applied for carbon credits, and the debate on whether, in fact, this was truly additionality, not whether there was wrongdoing, but whether this was, cricket. All right, and I think that your catalytic capital comments actually have tremendous relevance here, and that is what's going to happen in this phase of the market as many of these things go mainstream is that companies, entities, groups need to know who they really are and what they really serve. And I would submit to you that NGOs that have access to different forms of capital, different attributes in that capital, should be doing catalytic work. And as markets become increasingly institutionalized or mainstream, they should let other forms of capital that potentially are better suited to that take that and scale it and remain
and which are cheaper forms of capital, and which are more plentiful forms of capital.
And embrace these organizations. These NGOs should embrace their uniqueness and their, I'll call it power to do markets or applications where commercial ventures can't, and use it to blaze the trail, because their supporters, their grantors, their capital enables them to do that. And I think that the successful NGOs will be the ones that understand that concept.
Well, I've been watching that very thing at your side, and over the past few years at the Conservation Finance Conference that you help put on at Credit Suisse each year, which has always featured a good representation of exactly those kind of NGOs, sort of serving up new projects and new ideas, and having roots in the communities and projects on the ground that investors can get behind and learn from.
And then I think the sixth thing that we're going to take hold this year is there's this sense of globalization. It's not about COVID. It's along these sustainability things that, yes, carbon dioxide floats around the world and it's a global issue, but increasingly I think the conversation is going to migrate towards regionality, and it's going to migrate towards the cultural. And I think that this year we will adopt and accept the fact that it's not about the Western world coming to the rescue. It is going to be a global set of trends and requirements, but the conversations will take place increasingly about regional and cultural systems. We're seeing that now in food innovation. We're seeing that in terms of various forms of infrastructure, and whether it's right or wrong, we see this trend happening, and I think that there's distinct positive aspects of that.
I agree, and I was gonna say, and maybe end on this, because I think it just picks up on just what you said, which is not populism as much as popularity. Like, there's a need for the set of ideas that we're talking about, that you're talking about, to become identified as the growth drivers for prosperity and livelihoods and thriving communities and healthy kids. And those should be majoritarian or super majoritarian kind of political positions to have. And so kind of getting the people, as it were, behind this rebuild that you've been describing, I think is going to be a key thing in 2022 in obvious ways in this country, but in other countries as well, that, not some sort of elite affectation anymore, but really the future of business, the future of the economy, the future of communities, future of the planet.
Yeah, I think this is really now becoming part of pop culture, and there's dangers in that as well. But I'm looking forward to getting somebody selling a Ministry of the Future T-shirt.
Ministry of the Future, Kim Stanley Robinson's epic book, which has become kind of the Bible for the for a certain class, Dave, which we'll be watching. Let's leave it at that. If we come back to Ministry of the Future next year, and you've been proven correct in that, we'll be in trouble. So maybe we can do something about it in the year to come. So thanks very much. We'll check back with you obviously throughout 2022. Institutional Shift, Dave Chen, Equilibrium Capital. Thank you very much.
Thank you.
That's going to do it for this special Institutional Shift edition of the Agents of Impact podcast. You can read more about Dave Chen, Equilibrium Capital, and Institutional Impact at impactalpha.com. Subscribers receive full access to Impact Alpha content, including deal flow, job postings, and members-only Agents of Impact calls. Go to impactalpha/subscribe and use the code podcast100 for a $100 discount. Thanks again to Dave Chen and to our producer, Isaac Silk. I'm David Bank, and from Impact Alpha, take care.